Hey everyone, how's it going? Welcome to another video. I know it's been quite a while, so pretty excited to get back into it and run through today's video. In today's video, I'm going to walk through 4 examples of option strategies you can utilize on some stocks today, and I think they're really interesting setups. So at the end of the video, if you found value, if you're new to the channel, it'd be amazing if you could like, subscribe, really helps out the channel grow. So now jumping into the video, so for the first example, I'm going to cover Target and an option strategy you could utilize on Target. So what's interesting about Target here is if you see this chart, it's all the way down here at 140 in the past year, 140. It's kind of this lower threshold of where it's been for the past year. So I think that presents an opportunity for selling a cash secured put. So the platform I'm in is Robinhood, in case you've never seen it before. And I'm going to walk through the cash secured put. Effectively, you're selling an option, so someone's buying an option. You are selling the right for someone to put you the stock at whatever strike price you choose. And in order to do that, they will pay you a premium, which is effectively what you will earn extremely passively. So let me walk through the example and then that'll make a bit more sense. So for Target, what are you going to do? You need to select put and you need to select sell. The next thing you need to choose is the expiration. For these examples, I'm going to do about June 16th. It's 22 days out. It's kind of the monthly. Let's look there. And given Target's rundown recently, the past couple of weeks, I think it could be a good opportunity for selling the cash secured put. Now let's take a look at the option chain here. So as you can currently see, Target's trading at 140.75. Note, it's May 25th and it is right after the market closed, so just take that into consideration. If some of the premiums look a little off or the bid-ask spread is a little bit off, just take that into mind. Looking here, if we choose a 140 strike, which is fairly at the money more or less, you could collect $380. So this is just going to be an example to start. So if you select that, right now you're selling a cash secured put for $380 or $3.80, but effectively one contract has 100 shares, so you would earn $380, as you can see down here, today. Effectively, the person who's buying this option is paying you the $380. You're collecting this goes in your account today, and then over the next 22 days, you would monitor the option. If Target goes up to 150, 145, 155, whatever, on June 16th in 22 days, the option will expire worthless. This money remains in your account. It's already on your account starting today or whatever day you sell this option, and the option would expire worthless. Now, the downside with selling cash secured puts is if Target drops to, let's say, 130, you would have to buy Target at 140 and 100 shares worth, so that'd be $14,000, or you could close out the option by buying it back, but that would be a significantly higher price than what you're getting today, so keep that in mind. But the thing with selling cash secured puts, and especially on a Target, is you want to do it on stocks that you're willing to hold long term. So from my perspective, Target being a dividend paying company, a dividend king, raising its dividend I think almost 51 years consecutively, I think it's a great stock to own the long term, and this is a fairly reasonable price point to purchase it given the 1 year trend for Target's price point. So taking that into consideration, you could sell some cash secured puts around where it's trading today. So if you want to be conservative and you're like, yeah, I'm willing to purchase Target, but I want it to drop even more, let's look at the 130. So here, if you sold this 130 put, strike price of 130, and it expires 22 days from now on June 16th, you could collect 124 days today. In looking at this option, if you look at the Greeks, the delta is 0.17, so it's effectively 17% chance of expiring at the money. So that's just something worth noting. And what's interesting about this one, this is effectively a 1% return roughly in 1 month's time frame for the amount of capital that you'd be putting up at risk of being executed. So, a 1% ROI in about a month, a little less than a month, honestly, is fairly decent given this is money sitting in your account, not doing anything. So if annualized, that's a 12% return in theory. So it's worth looking at, the strike prices where you can get that type of return. It's definitely a little bit more conservative. Will Target go to 130? if it hasn't been there in the past year. But again, if this is a company you're worth holding long term, that could be a more attractive price and value point to purchase target at. So that's the positive and negative of a cash secured put strategy. Now, moving over to the second stock I'm going to cover today is UPS. UPS is a packaging delivery company. I'm sure everyone's heard of it. It's been around for over 100 years. Price earnings ratios less than 14, fairly low. And as you can see, the 1 year chart, similar to Target, it's down on this lower threshold area for the past year. And recently, I'm pretty sure they came out with earnings and came down. Yep, as you can see on April 24th, there was a massive drop off all the way from 195 to 172. And we've kind of been hovering around this lower range. So to me, I think it can be interesting. And again, I think UPS's dividend has consistently grown over maybe the past 10 years, but fairly healthy dividend growth worth noting. So what am I going to do for this cash secured put example? I'm going to go to 22 days out. Again, you could choose weekly, you could choose monthly. This is just an example of how to set it up. You would have to choose, what strike, what expiration works best for you. And again, if you're selling cash secured put on UPS, note you will need a fairly significant amount of capital. So first I'm going to walk through this example. It's currently trading 171. If we go to the 165, that's perfectly a 1% return in 1 month time frame. Less than 1 month since there's 22 days left. So this is a fairly interesting expiration strike price. Now, if you're like, well, I don't have $17,000 or $16,500, I can't trade this cash secured put. That's totally fine. I'll quickly show you what you can do to still trade UPS using a slightly different strategy. So what you're going to do is you're going to be buying a put now one leg lower. So effectively, you're going to be risking $250, the spread between 165 and 162.5, and you're going to be collecting $34. So you sold this put, but then you bought a put one leg lower, kind of protecting yourself. So the credit you'll receive today is $34. You're putting up $250 of collateral. That's over a 10% return in 1 month time frame, because if you put up 250, you collect over 25, that's over 10% return in less than a month. So slightly different strategy, slightly different ROI, slightly different risk profile as well, worth noting. Similar to UPS, the next one I want to cover is Tesla. Tesla is notorious for option traders, high premium, high volatility, but it's kind of been trending downward and kind of been settling in this range over here around 190, 170, 180. So let's take a look at selling some cash secured puts first, and then we'll look at that other strategy that I just walked through, which is the put credit spread. Setting this up, looking at the expiration, looking at the sell and put. If we go down here to the current trading price, if we go to 170, it's interesting, $335 over what, roughly 2% return. So there's a delta of 0.23, so fairly conservative delta, 23% chance effectively of expiring in the money. So worth considering. But again, this requires a lot of upfront capital to trade this cash secured put. So if you don't have $17,000 to trade, you could sell or trade a put credit spread. So what you're going to do is you're going to switch buy put. Now you need to choose a strike price a leg lower. You could go multiple legs lower. For this example, let's go 5 points. Let's look at the 165. So effectively, you're going to put up $500 of collateral, the spread between 170 and 165, and you're going to collect $95 today. So that's roughly putting up 500, collecting almost 100. That's about a 20% return in less than 22 days. The put credit spread on Tesla can be an amazing option strategy to utilize given the high premiums, the high volatility. Definitely worth looking into if you have a smaller amount of capital to use for option trading. It's a good starting place. You may want to use a stock that's a little less volatile just to get your grounding and experience with these types of options and trades. So that's just worth noting. The last example I'm going to cover is for Disney. As you can see, over the past 5 years, Disney's only really touched this 80, 90 price point in the COVID lows, and then only recently. So to me, this opens up a lot of opportunity. One, purchase Disney at a much cheaper price than where it's been trading the past couple of years, but also collect some income in the meantime by selling cash secured puts until I get put Disney. And if I don't, then that's amazing. I keep collecting premium and we'll keep selling cash secured puts. So let's take a look at some Disney cash secured puts. So to go to sell, we go to put, change the expiration to 22 days. So as you can see, the premiums here, not too bad, may not be as high given the implied volatility is a little bit lower, 30% for Disney, so fairly low volatility. Delta of 0.28 here. So if Disney's currently trading at 88, if you look at the 85 strike price and you sell this cash secured put for 85, you could collect $1.20 or $120 for this option contract. So that's over about a 1.5% return in 22 days, less than a month. So fairly good from a percentage standpoint, in my opinion. But if you think, okay, well, Disney may come down a little bit more and you want to be super conservative, let's look at the 80. This is almost 10% lower from where Disney's currently trading. So the key question you have to ask is Disney going to drop 10% in the next 22 days? And looking at this option, if you sold the 80, it has an implied volatility of 35%, a 0.11 delta, and you would collect $45 today. So that's roughly 0.5% return in less than 1 month's time frame. That's pretty good. If you are a long-term believer in Disney, you think this is a great purchase price and value to buy Disney stock, then selling the cash secured put on Disney could be a great approach or strategy for you. Hope you liked the video. If you found value in it, you learned something new, we'd greatly appreciate it if you like and subscribe. And also feel free to comment down below. Let me know what stocks you want me to cover, and also check out the links in the description down below for some awesome resources. Hope you have a great one.